How we doing? Awesome. So in this video, I'm going to talk about how IULs work. I'm sure you probably heard infinite banking, be your own bank, uninterrupted compound interest, all these amazing things. So in this video, I'm going to break down what it is, how it works, and if it's something for you, because this product is not a good fit for everybody, okay? So if you don't know, IUL stands for Index Universal Life, okay? It came out in 1997. It was a way some pretty smart guys wanted to be able to link their money to the market without directly investing it, meaning that they would get the upside of the market and 0% of the downside, okay? So in this video, I'm going to go ahead and break it down. So here are you. Here's Jasmine, okay? We got Jay for her, okay? Jasmine goes ahead and let's say she's contributing $1,000 a month in life insurance. I know what you're thinking. You're like, why is she doing $1,000 a month? Because that's what she wanted to do, okay? So when you get these IULs, it's the polar opposite as to why somebody would buy life insurance. So typically when you purchase life insurance, you're like, hey, how much life insurance can I get? I'm going to get the most amount of life insurance possible for the cheapest price, right? Now with IULs, you want to do the exact opposite. So you want to get the least amount of death benefit possible, and you want to dump the most amount of cash inside of your policy. So therefore, you're getting the best bang for your buck, okay? So you want to shrink your death benefit down so most of your money is not going towards the cost of life insurance. What do I mean? So she does $1,000 a month to the insurance company. Her money's going two different places, okay? Some of it is going towards the cost of life insurance, which is going towards that death benefit, right? So God forbid she were to pass away. Let's just say in this example, her family gets $250,000, right? God forbid she were to get sick, heart attack, stroke, cancer, she could accelerate 20 to 90% of her death benefit while she's alive, okay? And then this other component of her money goes towards this cash value accumulation bucket, okay? And so in this accumulation bucket, this is where your money gets to get linked to the market, not invested, okay? So since it's linked to the market, you can get most of the market upside. You don't get all of it, but you get most of it. And as a trade-off to you having a ceiling, you also have a floor where you're contractually guaranteed to never lose any money when the stock market is negative. Hence why so many people like it. And so you guys, this is not to compete with the stock market. It's not to compete with the bank. It's kind of a mixture of the two, right? I have the safety of the bank where I'm contractually guaranteed to never lose. And I also have the upside potential of the stock market. I might not get all of the gains, but I'll get most of them. So it's the best of both worlds. So it's meant to complement your portfolio, assuming that you have a great savings muscle, okay? So the money goes there. Let's say you get 6 to 9% uninterrupted compound interest. Some years you may get more, some years you may get zero, but let's just say the average is 6 to 9%. I'm being super conservative with these numbers, by the way, okay? And so now this goes into your cash value accumulation bucket. Some of the mistakes that I see a lot of people make is they think that, oh, I can take this money I can borrow from in a year, 2 years, 3 years. The whole purpose of this plan is you want it to have uninterrupted compound interest. Understand that these accounts cost the most the first 10 years, okay? But the cool part with these plans that many agents don't understand, unfortunately, if they don't sell IULs, is they say the plans get more expensive over time. They actually don't because you're self-insuring yourself because you have cash value in your account. So what happens is the more that this cash value bucket continues to grow, that's less responsibility on the life insurance company. Well, I heard when you die, you only get the death benefit. You don't get the cash value accumulation. That's not necessarily true because it depends on how your policy is structured. There could be instances where your family will actually get both. Okay. And so here you're self-insuring yourself, which actually long term, the policy actually gets cheaper the longer that you actually have your policy. Okay. And so register that you can borrow from this account. You can use it to send a kid off to college. Maybe you want to use it to supplement your retirement, but just understand you want it for long-term planning. This is not a short-term vehicle. If you want to borrow from it a year, 2 years, 3 years, this probably is not the vehicle for you. But if you're thinking long-term, hey, I understand long-term. I know I'm going to have this account for the rest of my life. This could be a great vehicle to help supplement your retirement and maybe help send your babies off to college, okay? If you like this video, go ahead, like, subscribe to it, comment your thoughts below. Make sure to share with a friend and get back to the agent that sent you the video. Let's go. Chase!